No, I think that's the wrong framework. I think what we see, for the reasons you mentioned, is we see a gradual tightening of monetary policy and financial conditions, in the US, which will have some repercussions globally. But we shouldn't be surprised by this. The fact is, it's been a long time since we've seen central banks tightening, so it feels different, but the reality is this is a perfectly normal process and will most likely be gradual.
So why are so many investors, and we've all read about Franklin Templeton and all these people yesterday, losing billions of dollars on trades around the world that they had pegged to a weaker dollar, a slowing pace of tightening as well, when, as you quite rightly say, nobody's changed the dot plot in a long while. This is what they painted and they said they were going to do. So why are there so many people getting it wrong?
Well, people who lose money, or you guys in the media, we all need stories. And so this is a comfortable story right now. But the reality is, again, this is a healthy, necessary, and most likely a gradual process that will be unfolding for some time to come.
Healthy and gradual for the United States, creating instability elsewhere because, as I say, some of the root causes of previous crises, and we can go back to 98, we can talk about 2000, we can talk about 2008, they are still there, and they came down to the same old things. We pull open the same textbook: current account deficits, capital flow issues as well, structural issues needed in many of these economies that just haven't been learned from previous crises.
Exactly. I mean, the reality is, if you're fundamentally weak or exposed, it tends to show up more when you have a U.S. tightening policy framework. But what we have today is the most exposed places are also fundamentally the weakest. And you can see this. If you had done a country risk, a sovereign risk analysis 6 months ago, Argentina and Turkey would have been at the very top. So I think what we're seeing is fundamentally exposed countries get more noticed and more exposed when monetary policy tightens in the U.S. But that's really the story. It's no more than that. I don't think we should overdo the tightening sort of story here in terms of repercussions.
The trouble is, we've seen this movie so many times before, Philipp, but let me ask you, is it different this time and we can all breathe easy? We are not heading into contagion or an emerging market crisis.
Well, I think what's different is we have overarching, we have some big risks. And I think the biggest one continues to be the trade risks. Are we fundamentally changing the global trading system, which would be severe because we have very complicated, very complex global supply chains today that are very different from 15, 20 years ago. And so this, to me, is by far the bigger risk to the global economy than the fact that the Fed is tightening.
So Donald Trump is a bigger threat to the global economy than Jay Powell?
Well, it's the uncertainty around global trading policy.
You could have just said yes. That would have
well,
been okay.
I would say the policies that are embraced by the U.S. administration around trade represent the biggest risk today to the global economy.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.